it's time to bring in our special guest. Charles Kirkpatrick is here with us. And really, for me, the way I was introduced to Charles was through his book, Technical Analysis, the Complete Resource for Financial Market Technicians, and found it to be very good. It was part of my CMT studies. So with that, let's go ahead and get started on what you have for us today. We're really excited to have you here.
All right, well, let me start first. You're going to see in my presentation a lot of, not necessarily formulas, but a lot of assumed correlations. And I just wanted to mention that when I do this, I always do it after having tested everything. I'm a very large skeptic of technical analysis that hasn't been demonstrated to show profits, which is what we're looking for. So please note that when I do say that there's a correlation or there's some reason to be doing this, I've tested it. And if I haven't tested it, I'll say so. Okay. Rule number one is you have to be concerned with risk more than anything. In fact, picking stocks, which most people do or spend their time doing, is almost irrelevant. You could throw a dart at a newspaper and pick stocks, but if you are able to control your risk, you'll make money. And so it's very important when you look at any method that the risk is taken into account. Now, on the left-hand side, the wording there, that you shouldn't be spending your time buying, you should be spending your time selling when the risk is too high. And the other thing about risk that confuses people and is a terrible misdefinition is to equate risk with volatility. Risk and volatility are an academic association, but not an investment association. Volatility, well, if you switch over to the middle chart where it shows stock A, stock B, stock A declines by X amount, stock B advanced by X amount. Now, both of those stocks have the same volatility. Which one do you want? You want the B, obviously. So volatility itself has told you absolutely nothing. And risk then is not volatility. It's basically the odds of losing money. That's what you're worried about. Now, on the right side, there's a chart of the portfolio that are, it's a fictional portfolio that we run. And you'll notice going back into 2008 and again in 2011 and again in 2015-16, where I have the circles, that the ideal portfolio was flat across there. That's because it was out of the market. Being out of the market is extremely important when you're going into a decline. Obviously, during advances, stocks can be non-correlated, and there are people who trade that, but being non-correlated means that you use relative strength to pull out the ones that are the best, because basically stocks are going in all directions. But when you go into a decline, all stocks become correlated, and they're correlated in the decline. So that's evidence as to why you should not be anywhere near a stock in a decline. Now, next, capital loss. The other problem with loss as a risk is that you also lose time. And if you can sort of envision this is the last 10 or 12 years in the market. And really, if you started in 2000, the year 2000, that's and gone all the way to 2013, you haven't made a cent. And taken a few hits in between, a few scary ones. So, and it's going to take a long time, when you have the corrections, as you did say in 2000 to 2003, it takes you 6 years to get back even. So you don't want that. You want to be out of the market. You want to be in cash when the thing makes the bottom, and so that you can add that leg to your portfolio profit, not consider it as a return of back to where you were. the basic things that I look at for market timing are these three mentioned. Sentiment is I look at, but sentiment is more short term, and it well, for that reason, it's not as useful. The only aspect of sentiment that lasts for a while is, and it's really included in the money section here, is margin debt. Margin debt takes a long time to develop, and right now it's at historic highs, so it's telling you that you're in a speculative market. But we know that anyways, just from the price curve. So money is the second one, and I have a chart here of this, the S&P 500 relative to the Treasury bond, and the old rule of 3 steps and a stumble, which goes back way back, and it was just triggered here this spring or this winter when the Fed raised the rates 3 times. That's almost an infallible indicator. And then, of course, the technical is what I really focus on because that's what I experiment with. And the old moving average crossovers are adjusted for duality and they're filtered. We'll get into that a little later. And then using the Wilder Directional Index, which is called the DMI, that is extremely good in timing. Next chart, I throw up the Fear and Greed Index. Now, I noticed in the paper this morning that, and you'll see that the first of the ingredients of this is the market volatility, the VIX, and the SEC is going after somebody, I don't know who, for manipulating the VIX. Even so, it's a function of the volatility in the S&P, and I don't know how you influence it except over very short periods. So there's a list on the side there that shows the breadth and the market momentum and how they calculate it. It's done by CNN Money, and at this point it's very low, showing extreme fear. So again, that's suggesting you're in the midst of a rally, but not necessarily a bull market. Now, this is the ratio of the Treasury bond interest rate, 30-year rate, the TYX, and the SPX, the Standard & Poor's 500. And there's a direct relationship there that when the moving average of that index turns up and the index itself, in other words, the ratio crosses over the moving average, you get a buy signal, and conversely for the sell signal. And this chart shows the results of that. And we're still in a buy frame. As you can see, the last buy was back in 2015. So money supply, or money, is sort of somewhat bullish, but old. It's aging, let's say. The high margin debt is not good, and you had the three steps and a stumble. So 2 out of 3 are negative. Not convincing quite yet, but we're getting close. Now, in the technical aspect, I use what's called a dual filtered moving average crossover system. The dual means that when you look at the moving averages, one moving average is not necessarily good for both buys and sells. The reason being is that the character of the market is quite different when it's in a decline than it is in advance. And sells, when it's in a decline, for instance, you'll have spike bottoms usually, and you'll have rounded tops. Now, a moving average, in order to trigger on any one of those, has to have a different period, a look-back period. And so the dual means that there's one for buys and one for selling. Filtered is just merely a means of reducing the whipsaws you often get in a moving average system, where it just goes below, for signals a little thing and then suddenly whips up. Well, if you add a filter. In other words, a certain amount by which it has to go in addition to the crossover before it signals. Then you reduce those whipsaws. And again, this has all been tested. And I also use walk forward optimizing, so that it's usually pretty good for the next, in this case, probably the next year. And then the moving average crossover means that if you're looking at the buy line, you're only looking at the times that it crosses up through the one line, and you get a buy signal, which you had back in April of 2016, and you haven't had a sell signal since. So that's looking favorable. Another method that I use is sort of a reduction or a rearrangement of the old DMI method of Wilder. Wilder's invented some really magnificent stuff, but in this case, the DMI is really two indices. One is, and you can see it at the bottom of the chart, the blue line, squiggly line, is equivalent to buying pressure, and the red one is equivalent to selling pressure in the market at each instant. And obviously, when the buying pressure crosses the selling pressure, that's usually a time when you want to be long, because it means that the trend has reversed upward. Now, the conventional way of doing that is with what they call the ADX. And what I do is, instead of using the ADX, I measure the spread between the two, the spread between the buying pressure and the selling pressure. And when that reaches a peak, that usually occurs at some kind of turning point, and you don't know what the turning point is going to be until it begins to contract. And by testing, you come up with the amount by which it has to contract in order to give you a valid signal. In this case, the buy signal was way back in, April of 2017. And you can see the little blue arrow there. And just on the decline here a couple of weeks ago, or a week or so ago, you see the red arrow, and that's where you got a negative crossover. So that means for the intermediate term, you should be out of the market, or at least very cautious in what you do. So once you know that the market's going up or down, or you expect it to be going up and down, your next problem is finding out what you want to put your money into. And you only do it when the market looks favorable. And what I've found, and it's probably the only method that has been, not authorized by academia, but academia has a terrible time with it because, as you know, the efficient markets hypothesis argues that there is no formula that can beat the market for selecting stocks. Well, that's a problem in this case because they have demonstrated even themselves that the relative strength works. Now, the variables, of course, are different. It depends on how far back you're looking for the relative strength, how you're constructing the comparison, and so forth. I use two methods. One is called the Levy method. And what that does is takes the ratio of the closing price of every stock and a ratio of that closing price to the 30-week moving average of that stock. It gives you a number, that ratio. Obviously, the stronger the stock, the higher the ratio. That is then ranked, or that ratio is ranked, and those stocks and divided into percentiles so that it makes it easier to figure out what the relative what the relative value is. And through experimenting with, here, let me show you the next one. This is a graph of the relationship between the relative strength based on that Levy method and the post-performance 3 months out. It also works out 6 months, 9 months, and 12 months. but this case is more dramatic with 3 months out. The graph is sloped upward, and the bottom is the ranking, the percentile that I mentioned. And you can see that the high percentile, where it was 92 to 97, really 97, the performance, which is on the vertical axis, is the highest. And then it goes downhill as your relative strength itself goes downhill. So very simply, it's telling you that you want to buy stocks that have or exist in the top 97th percentile up. The high number is 99. So 97, 98, 99. Those are the stocks using this calculation that you should consider. Now, there's another way of looking at relative strength. Oh, I'm sorry, I jumped ahead a little bit. No, I didn't. Sorry. There's another way of looking at it. For you as an individual, it's very difficult to come up with a ranking system because you have to have a computer that sorts large numbers of data. So I found an easier way of doing it, which you can do on an Excel sheet, and that is just to take the ratio of the close to a moving average, and then using that raw number as a guideline as to whether you should buy it or sell it. It turns out that when you do this, for instance, the relative ranking system produced about a 28% CAG, which is a compound annual growth rate. And when you do the absolute, which I'm trying to describe here now, you do a 25% CAG. So it's not quite as good as the ranking method, but it's a hell of a lot easier to calculate. And you can use this at home. What you need to do is take a ratio, as I said, and the ratio is the close to the 61-week moving average. And it's the SMA. I don't use the exponential or the or any of the others for that matter. The results are more or less the same. And in this chart, you see Weight Watchers International, and the blue line and the red line down there at midpoint are the ratio level at which if the stock breaks up through that level, that ratio, is a buy. And then if it goes through the red line, it's a sell. Now that number for the buy is 1.47 using that ratio. You want a stock that has that number if you can't calculate the relative strength. And you can see you get the buy signal in Weight Watchers way back in April at roughly $20. And it has so far failed to decline below that low red line. So it's still a worthwhile holding. Now, next question then is, okay, you own some stocks. They all work out on the relative or the absolute relative strength method. When do you sell them? Aside from when the longer term market indicators go negative. You sell them when they either hit the levels that I mentioned in the ranking system. If it goes below 58, you want to get rid of it. And in the absolute one, if it hits 1.04, and then you want to get rid of it. You should never have a stock with that as a ratio. The other method is a classic old chandelier stop, which is a stop on your price that's regulated or includes the average true range. Again, another Wilder invention. And when you're testing it, there's two variables in the chandelier. One is, of course, the look-back period, and the other is how many look-back period for the ATR, the average true range, and the other is how many of those particular ATRs do you need to get rid of the stock. this particular one right here is 17 weeks back, and it's 3.1 ATRs, and that is subtracted from the high. You never lower the stop level, even if the volatility dies on you. All that will do is bring you down closer to the stop level, but it will never. You never want to have it so that it breaks, or the stop level goes down. If it goes through it, well, then you sell it. It's simple as that. And then the final is this is the list of, or the beginning of a list that I publish in my Market Strategist, and it shows the stocks that are added, subtracted, the bargain list, where they were bought, and so forth. It's just a history, and that's what goes behind that chart that was on the first page. I don't hear any question. Yes.
I'm kind of looking at this stock selection and exits slide that you have up here, and the last one gets my attention. I'm sure it gets a lot of folks' attention. Sell all stocks when a majority of long-term market indicators show a bear market approaching. When you talk about your long-term market indicators,
right?
Everyone gets scared. I mean, we saw the last 2 weeks the market takes this big drop, and of course, anytime we see some selling, there's going to be an immediate debate: is this bear market starting?
Right.
What types of long-term market indicators are you referring to there?
Well, certainly the money aspect. Well, actually, all of them. They all. What happens is that different tops have different characteristics. The top that we've just gone through is a classic speculative market. You have a accelerating upward curve in prices. You have a tremendous overbought. You get tremendous enthusiasm, optimism. Money starts to tighten, and then it breaks on a first break. But people have to remember that even in 1929, it took 3 years to get to the bottom. So most declines don't go from top to bottom, and if they're going to be a very deep one. So by understanding how these particular kinds of tops work, the surprise. Oh, and the other thing is that usually you get a big sharp down off the top in a speculative market that nobody can understand, and I haven't heard a good explanation yet as to why we suddenly took out the amount of points that we did. But classically, you then have a rally, and as you have this rally, you'll see the longer term, like the dual moving average filter and these sort of things, begin to turn down. They've already started to turn down, but they get down to that sell point, so that when you break on the next decline, and that could be, anywhere from 3 months to next fall sometime, or not maybe 2 months until next fall. At that point, then you've now demonstrated that you definitely are have made a long-term top, and that's when you want to get rid of everything. The thing is, while you're at the top, relative strength continues to make money for you. It's the majority of stocks may be peeling off, but the relatively strong ones are the ones you want to stay in because they continue. And you pointed out a few today that I think VIPS was one, and I forget, there was a couple of them that were making new highs. That's totally characteristic, but that list of stocks making new highs will start to shrink, of course, as the rest of the market weakens. And so that's what we're waiting for now.
Okay, so at this point, are you ready to say that we've started a bear market, or are you saying that there's still not quite enough evidence out there?
I want a little more evidence. I'd like to see that rally that we're presumably starting now, or have started, and just see what happens to it. Yes, I think personally, I think you've seen the peak, but I can't confirm it yet. You got to wait for that rally to see what happens there.
Okay. Well, it's just pretty interesting. This has been obviously a pretty big discussion that we've had on the show for the last couple of weeks with the big drops and the volatility spiking. And of course, you have to have some fear in order to get the market selling the way it's
Right.
sold. And so the question is, I mean, we've had some of these spikes in the past where we've seen the fear, but it's been a correction as opposed to a bear market. And
That's
I guess,
correct.
what happens from this point forward really is going to give us more indication of what we're facing.
Yeah, the difference this time is that you had what's called an accelerated curve. And they're characteristic of speculation. Now, can we go and speculate some more? Well, I suppose we could. But they're the panic in reverse. A panic usually starts off relatively slowly and then, falls off quicker and quicker until it hits the bottom. Whereas a speculative advance has this sort of slower at first and then gradually accelerates up to its final peak. And then you get a big smack off of that peak. You never know beforehand where the peak's going to be. But when it does smack, one of the characteristics, as I think I mentioned, is that nobody can understand why. It's a total mystery. And it's sort of like 87. Nobody could figure that out either. Still can't. But can you later on, out 3 or 4 years, continue up? Of course, that's possible. What you're worried about is the next few years.
Okay, well, we have gotten to a pretty good point, but there was one question that came in that I saw in the chat room, and I don't know, Aaron, if you have others, but one question in particular was asking about the books, your books, and I know we have your books in our bookstore, but how many books have you written?
Well, on the market, 4. I wrote a hunting guide once.
Oh, awesome.
Well,
I do.
Maine and New Hampshire. And
Is this hunting for stocks, or are you talking about animals?
No. I'm talking about furry animals and fishing.
Okay, I got you.
Well, we have a lot of interest in some of these studies that you're showing us. And should we just direct them to your website at charleskirkpatrick.com where they can?
Yeah, that's probably the easiest. Yeah.
charleskirkpatrick.com. Right. There you go, guys. That's where you can get most of this information, I would imagine.
And I know you've got probably a lot more that you could share with us, Charles. We'd love to have you back if you have
sure.
some time in your schedule. Would you mind coming back and joining us?
No, I'd love to do that. Thank you.
That would be awesome. I mean, I know you've got other things that that interest you in the market, and a lot, obviously, in your books. You got a ton of information that folks really should pick up a copy of your books and take a look at. So we'll definitely have you back for that. But
yes, we have people in the chat room already saying, yes, please come back.
Well, it's hard to put that much information into the short period I had.
Yeah, I know how that goes. Very nice. And thank you, Charles. Really appreciate it.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.